In this lesson, we're going to take a quick look back at the different order types and talk about the strengths and weaknesses of each. Let's begin by looking at a summary of stop orders. In the top left, you see a simple entry to go long at $34.30 with a stop market order to exit placed just below the demand zone at $34.15. In the upper right-hand corner, we see a short entry with a sell limit at $34.30. You can also see the short exit, which would be a buy to cover type of stop loss at $34.45. Remember, since we are short in that case, we already sold the shares. Therefore, our stop loss is going to be a buy to cover at market. In the bottom left-hand corner, we're looking at a stop limit order. The difference here is we will not be using a stop limit order as a stop loss, but rather as an entry into a confirmation trade. As you can see, price came into the demand zone. So in that case, we set up our stop trigger at $34.31, 1 penny above the proximal line of the demand zone. We set it with a limit price of $34.33. This tells the system that we want to send an order only once the price hits $34.31, but we don't want to pay more than $34.33. In the lower right corner, we have a short example of a stop limit entry. Here you can see the price has come up to our supply zone, and once it leaves that price point, that's where and when we want to go short. So for this example, we set our stop price at $34.33, 1 penny below the proximal line of the supply zone, and a limit of $34.31. This tells the system that we are willing to accept 2 cents worth of slippage on our order. So now let's review some basic orders for buying. The first step when looking to go long is to identify where the current price is. In this example, it's at $40. If we're looking to buy at the current price or a price higher than the current market, we would be using a market order, a buy stop limit order, or a buy stop market order. If you're looking to buy below current prices, you would be using a limit order. When entering long, the exit is a sell order. To protect your trade, you would place a sell stop market order to exit for a small loss below the current price. For the profit target on a long trade, you would be using a sell limit order at a price higher than the current price. Let's look at an example. Here we have a buying example. And here we can see prices in a strong uptrend. We identified a demand zone where we would be looking to buy long if price pulls back to that demand zone while the trend is still valid. To map out our trade, our entry will be a buy limit order below current price at $48.26, per the example. The stop loss would be a sell stop market order below current price at $48.18. Our profit target would be a sell limit order above the current price at $48.97. So let's see how this trade plays out. As you can see, the price fell to the demand zone. Having gone below our proximal line, it would have triggered our buy limit order to go long at $48.26. Then the price proceeded to rally up to the profit target where our limit order would be waiting to sell at $48.97. Now let's flip things upside down and take a look at a shorting example. The first step is to identify where the current price is. In this example, it's at $40. If you're looking to short below the current price, you would be using either a sell market order, a sell stop limit order, or a sell stop market order. If you're looking to short above current price, you would be using a sell limit order. If you're short and prices start to rally up and go against your position, you would look to exit for a loss using a stop loss as a buy stop market order above current price. If you're short and the trade moves in your favor to the downside, you'd look to exit for a profit at a target using a buy limit order. Let's look at this on a price chart. The left side of this chart shows an aggressive sell-off followed by a lengthy price recovery back up towards prior supply. We have identified a supply zone between $60.60 and $60.93. We'll begin by looking at our entry. That will be done utilizing a sell limit above current price at the proximal line of $60.60. Next, we need to plan out our stop loss should this trade not work out. The stop loss would be a buy stop market order above the supply zone. In this case, that would be at $60.93. Finally, we look to set a profit target using a buy limit order below current price. In this example here, we have targeted a previous area of demand at $57.85. As you can see, the price rallies back up to our supply zone and the trade is short at $60.60. Knowing we have our stop loss in place and are protected, we let the trade play out. Price begins to drop and ultimately falls back to our target. So when do we use these orders? A market order is used for entering and exiting a position immediately. The good thing about this is that you're going to be executed immediately. The negative side is that you may suffer slippage, which is where you might not get the price that you thought that you were going to get. Limit orders are used to specifically plan entries and exits. The good thing about limit orders is that you will not suffer any slippage because you are specifying a particular price and you may even get a price improvement on your order. The downside here is that you may only get a partial fill or you may not get filled at all. The stop market order is used primarily to exit a trade for a loss. However, you may also use this for an entry as well. The positive side of a stop market order is that you are going to get out of the trade should the price movement go against you. The bad news is that you may suffer slippage because it utilizes market orders. And finally, the stop limit order. This is used as a stop loss for breakout entries. However, as you can see under the negatives, we strongly recommend that you do not use a stop limit order as a protective stop, as there is no guarantee that you will get filled. Since it uses a limit order, the positive side of this is that you may get filled at a better price. So there you have it, all the order types, including stops, all wrapped up. As you practice, use a virtual account to work with each order type to get used to entering them into the market and entering them into your preferred trading platform. Identify when to utilize their strengths to your advantage or to avoid using them at all. Before you move on, memorize what types of orders, both entries and exits, you would consider placing and where as a seller at a supply zone. Also, memorize what types of order entries and exits you would consider placing and where as a buyer at a demand zone. Hope to see you in the next video.